Good morning. Welcome to the Brew today, Traders Workshop Thursday. We're going to continue our conversation on zero DTEs. I'm knee deep into these darn things. We'll see what the lads have to say about this. And we're going to chat a little bit about IV versus HV. I think there's some interesting findings. So stay tuned for the opening bell. Good morning, gents. How are you?
Morning, Lex. Good morning, Jason.
Hello. I'm doing good. I've got battle fatigue, meaning I've traded so much since the last time I saw you that my head's spinning.
Yeah. And your broker's cash registers are ringing.
That's right. It's all because of you, Jason, because I'm looking at that Volland and trying to figure out what levels I should be in at and all that kind of good stuff. But all good, I would say.
Yeah, I mean there's people in my Discord that sit there every 5 minutes and they're like waiting for bated breath, and they're excited seeing a little circle every 5 minutes of some new update, new update, new update. They're like, oh my goodness, sell this, buy this. I'm like,
yeah. No, I've been enjoying it. Although I will say this, relative to our last conversation last Thursday, I've become the broken wing butterfly fan, like to the nth degree. I can't figure out why I love them so much. I think it has to do with the fact that you can buy these things super cheap, and you can, obviously you can play the direction, right? That's the whole point. So I've been loving those things. And they inevitably, if you get some part of the direction correct, they inevitably expand a little bit and you can pop out of them. So I don't know. Help me where I'm wrong. I love them though.
Well, the thing with a broken wing too is it's true of any butterfly, right? But there's so many adjustments you can make to, pull in the tail, lock in profits, extend your risk a little bit more. Like there's so much flexibility with that structure.
Yeah. Yeah, I really, someone was asking me why the broken wing the other day, and I said, here's why I like it. You have, let's say I'm doing a $2 on the top side. I'm looking at a put, so, the higher end. So I'm doing a $2 one that I'm buying, and then I'm selling a $1 spread. So I've got, 2 strikes in between my long and my short, and then 1 strike between the bottom long and the short, the middle short, right? So I got a $2 spread versus a $1 spread. I can make money down to 0 on this spread, right? Because my $2 spread is going to go to 2, my 1's going to go to 1. I'm going to make $1 or less what I pay for this thing. So that's kind of cool too. I don't have to hit it, pretty nice. I can be in the right direction. I can blow through it. I can still make money on it, which I love. I love that. So
it's like a call spread or a put spread or like a regular vertical, but in payoff, it's similar in that, but you get the little kicker if you're dead right on target.
Right. And I got to tell you, thanks to Volland, I've hit 2 of them right on the nose. Like maybe, a dime either way. That's a plug, Jason. Wait, hold on. That's a plug. Did you hear that? Good golly.
Yes. I'll do mine. Yeah, no, Volland is really good at identifying those that spot where the dealers stop.
Yep. Yeah, no, I'm learning more and more about it. So,
yeah, I mean,
yep. What were you gonna say? Sorry,
you had questions about it, but today is I know, I guess it's recording, but today is Tuesday. It's not Thursday. I know you said Thursday before.
Well,
but,
see, that's
if I show Volland, it's gonna be.
Yeah. You're supposed to pretend it's Thursday because we're gonna play this on Thursday, so we have to think in Thursday terms. And you're pretending.
Okay, but Volland will be wrong. It's a Tuesday Volland for a Thursday recording.
Okay, so thank God you admitted that we're looking at a Tuesday Volland for a Thursday recorded aired show.
Right.
I love it.
And today's very bullish, so it's kind of
right.
So everybody who's watching will have the benefit of hindsight.
Yep. Well, let's take a look at Volland real quick, and then we'll talk about IV and HV.
Okay.
Tell me, okay, so I don't remember the paradigms after the book I read on what this one is. Mark, you were better at this. Is this GEX? I forget now.
Are you going to put me on the spot?
That's okay. Don't worry. There's no, you don't get a grade.
I think so. I think this is pretty Jexy.
Jexy.
This is
Jexy. Is that right?
So, yes. So here's the. I'm gonna throw up some of our historicals here.
Okay.
Because the market moved pretty fast, and at around 10 o'clock, let's see. I want to do just today's expiration.
Okay.
So around 10 o'clock, I was seeing that's something very similar to this. Mm-hmm. And you see this 4505. That's the, when you have a JEX paradigm, usually the largest strike is the target. And, at 10 o'clock today, this morning, I, put up on my announcement, we're looking, JEXy up to 4505. And
is that strike?
That's this strike right here.
Yeah. Okay, so let me ask another question.
Right there, 4505.
Why isn't that big green bar important? That seems bigger than any bar that's on that page.
It is very important, but if you look here on the bottom, the cumulative chart is showing that it's net negative. So even though it is important, it is it's basically being overshadowed by all the red around it.
Okay, so the bottom chart is a cumulative of what? Sorry.
So you start from at the time, I guess it would be right here, the current price. Mm-hmm. And what we do is we accumulate going both directions. So the current price will be at 0.
Okay.
And we start adding all of the strikes next to it. So the big green bar would be here between 44.60 and 44.55.
Okay.
Now we're coming out with a new page that'll just kind of consolidate all this for you. Yep. But if you add both ends, right now so at 10 o'clock this morning, it would have been 72 million and 193 million. So it's almost like 250 million, which is actually a lot for this early.
Yep.
So it's important, but you can see it's kind of dwarfed by all the other red around it. Mm-hmm. When the cumulative is negative, on both sides, that's a JEX paradigm. Okay. So when it's JEX, they have kind of, what I like to call a line in the sand around here, around 44.50, because this would flip negative and make it even more bullish if it were to cross, if we were to drop. But so if it crosses and it just keeps going, that means somebody is, or a lot of people are selling down past, and this could get ugly.
Right.
But ultimately, it's very bullish. But as the price increases, all these turn to green, and around 4505 is where you would see a little bit more balance, so to speak, where net charm is 0 and dealers are happy, right?
Okay. So let me just repeat a couple things. I want to make sure I got this. So go back to that the JEX chart there above. There you go, right there. Mm-hmm. So when we break through the 4405, I think you said, or I can't remember what you said, 4505.
4505 right here.
That turns green, that one there, right? Mm-hmm. So as the day goes on, dealers are going to get longer and have to sell some of that delta, right?
Yes.
Mm-hmm. Okay. So
not so much as the day goes on, but as the price moves up. And then once it moves up past here, then as the day goes on, yes, they'll get.
Unless we blow through it for whatever reason, then it's a foregone conclusion. It's all hedged. We're not going to worry about it, right?
Mm-hmm. Right.
Okay. Got it. So that makes sense to me. Okay. I think I got it.
So now this is a target. And now the definition of a target is that we will reach it at some point in the day. Once we reach there and dealers kind of get hedged, we could pull back. They're okay with that. But we reach it at some point, not necessarily close there.
Mm-hmm.
Okay.
Mm-hmm.
However, when you have like a line in the sand, like the other paradigms, the Bank of America paradigm, where it's kind of like a you see 2 strikes, 2 lines in the sand. Those are supposed to hold until the end of the day.
Okay. You got to show me one of those when we see one next time. I gotta understand that. Okay. Yeah, I mean, I've been using this a good bit. So Mark, do you get all this? Do you understand all this as well? So are you getting the setup sort of thing?
I've got to rely on my trusty user guide that Jason shared with us.
Yeah,
I
I
got my
use that
little
a
cheat
lot.
sheet going.
Yep.
I'm not like on the tip of my tongue which charm profiles I'm looking at, but yeah, the cheat sheet helps a lot.
Yeah, no doubt. I've been using that a lot too. Okay, yeah. So I really like this, and I like setting up. I think I like setting up short premium trades, like Iron Condor kind of things, with these for the most part. Although,
well, this one I would have done one of your broken wing butterflies and made sure that, I would probably have centered the butterfly a little bit south, like here at 44.95 or so, because when you break the wing and you break the wing, more bullish, then you still have kind of like you're still making money even past the middle of the broken wing butterfly.
Oh yeah, sure, absolutely. That's what we talked about earlier.
And then so if it retreats, a little bit, you're still within the meat of your butterfly, so it's still, it's still very good. That's why I like the broken wing butterfly, because then I can center it in a place where if it doesn't quite reach the target or something like that, you're still in the meat of your butterfly. It's still kind of a bullish push, and you're still making money even if you haven't exactly reached your target.
Right. No, I like it too. That's good. Yeah. So those have been wonderful. I really like those a lot. The other thing I'd say is I've been trading XSP with this setup only because I wanted to do well. I like the 1/10th version. I also like dollar strikes. Tell me I'm mad, right? Why do I like dollar strikes instead of $5 strikes in SPX? I feel like I can't get smoked as bad with the dollar strikes. So I definitely like messing there, and I can always pull them out a little bit as needed. So, but the bad news is that XSP still has super wide markets. They're not as tight as SPX, unfortunately. So
yeah, you tend to get, you're probably like a penny or two on either side of the mid, especially if you're like out of the money. But I like SPX for the short gamma because of the thinner, the notionally thinner verticals. But and also, I think it's more granular. But I think XSP, especially for long gamma, because those wings on XSP seem, and maybe it's just in my head, but those wings on XSP seem to degrade pretty quickly. So I like doing XSP for long gamma.
Yeah. No.
Plus, it's less capital, and I like less capital.
There you go.
I had a question for you, Jason. How often do those inflection points? I mean, it's probably somewhat self-fulfilling, but like, how often do they occur at round numbers? And like, there's some degree of customers wanting to trade those options anyway, which naturally puts the dealers at those, or positioned at those, strikes. But just from your observations, how does that tend to be sort of borne out?
So when you say round numbers, I'm assuming you're meaning anything that has a multiple of 25?
Yeah, or even, like 4,500, I would say is like a big round, like even bigger than 4,400.
Yeah.
So it tends to, I think when there are strikes that are made that day, like if, today with zero DTE trading, you can tell 4505 was made today. Like people sold those calls right away. The round numbers are not as important, but sometimes when you're going into the day, somebody, like usually on Friday in particular, somebody had sold like a ton of calls at 4,500 2 weeks ago, and all of a sudden now you're on zero DTE, and that strike is huge because you're right there. This happened last Friday, where I think it was 46. I think it was 4,600 or 4,610 or something. It was 4,610, so it's not a round number, but it tends to be round numbers on Fridays, where there's a huge charm strike going into the day already. So you can kind of even tell the day before we might be a little bullish up to this strike.
Nice.
But then tend to be
that
round
makes
numbers.
sense that it's more the latent OI rather than the day of OI that is round number focused. Like that definitely jives.
Okay. We only have a few minutes. We're on a short version today. Let's talk about IV versus HV. We chatted about that pre-show. Are you guys seeing anything unusual, interesting with implied volatility versus realized or historical? I mean, don't jump at
Mark,
once.
you want to talk?
Don't jump at once.
One of the tools that I've been messing around with more recently, again, is using the Garch model to estimate historical vol, because I feel like implied vol has been chopping around quite a bit. I mean, just in the last 2 weeks, we saw how much like the 10, 30-day section of the curve has just gotten smushed in SPX. We went from like 17, 18 vol to like 12, 11 vol. And like, that's a big difference for 2 weeks. Like, I don't believe the same way market drops 10%. I don't believe that like the discounted future cash flows of all of American companies have changed by 10%. Like, and I think vol has some of that like over under reaction aspect to it too. So to get like a little bit more of a, steady perspective on it, I've been using the Garch model that, sort of models different phases of volatility and has it relativizes volatility to the overall environment too.
Okay. Are you seeing inverted IV HV? I mean, when I say inverted, I mean IV less than HV, which in the old days I hardly ever saw that. I got to be honest, it wasn't very popular or very prevalent. Are you guys seeing that at all?
Well, to me, it's a term. It depends on what measure of HV and IV really that you're using. But if you're using just the CBOE indices, CBOE has an index card RVOL, RVOL. You can get it on the website. I think you could probably get it on some brokerages. That is the 30-day realized volatility over the past, you could almost say historical volatility over the past 30 calendar days. And that RVOL is around like 15.8 or so percent. It's like, for HV.
Right.
If you're looking at VIX, the CBOE index for implied volatility for the next 30 days. Today on Tuesday, that's sitting at 14. Typically, historical volatility is much lower than IV because that's basically, you could say, the price of gamma. Because you have exponential returns on options, you have to pay a certain premium or risk premium in order to account for that. This time now, though, you're almost getting paid for volatility, paid to take volatility. It's no longer really a carry trade. So I honestly, like, I'm seeing it, as you said, it's kind of backwards. It happens sometimes, but it's not unprecedented. But this is rare. And I mean, over the past 3 weeks, we've seen quite a launch in stocks. And I think we went from like 4,100 now, and we're at like 4,500. It's 10% almost gain. And in that time frame, though, like Mark observed, the VIX has declined way more than, I guess you could say, the correlation implies. So because of that, though, I mean, even today on Tuesday, where we're rising by like 80 points, I'm very skeptical. I'm kind of, I'd be very careful going long, because implied volatility at some point in time is going to have to snap back. This is option expiration week, so and volatility expiration week, and maybe there's some kind of structure that is about to expire or something that's kind of suppressing vol a little bit, and we can end up back where we started pretty quickly.
Yeah. So what do you like to do when we have this setup, which isn't very much, when IV is hovering lower than HV? Are you buying straddles? Are you buying strangles, or is that just too dangerous in and of itself to take advantage of a little gamma?
Yeah, I mean, typically like a calendar or diagonal is a good idea, because that's long. It's a long volatility trade, and kind of more position it closer to the downside, mainly because implied volatility usually results in lower indices. Implied volatility rise is usually results in lower indices. So if you do kind of like a diagonal or something like that,
Yep.
there are, obviously there are macroeconomic things like CPI today that will that can hurt your position. So if you do kind of a diagonal that is further down than you think, then like the lows or something, and a diagonal is basically like the calendar's version of a broken wing butterfly. If you break the wing so that you don't lose much if you go up, or if you may not lose anything at all,
Right.
then that could be that's probably the right trade for this scenario. You just have to be careful of blowing through it to the downside. So you kind of want to, if you're doing a diagonal, you kind of want to make it so that it is further, it is lower than you project SPX would go.
Got it. Okay. Interesting.
And sell it when it's delta neutral.
Right. Mark, do you have any particular favorite play in this environment, or not really?
Well, one of the other interesting things about the environment is that it's how notable how much of the moves are occurring overnight. So like the realized vol is a pretty traditional measure of historical realized volatility using close to close prices. But if you use one of these like average true range, or I use the Parkinson's method of calculating historical volatility, where you're looking at the high and the low intraday, that number is significantly lower than the close to close realized vol. So most of these moves are actually taking place overnight. Particularly recently, right? Like we opened 60 points today or 70 points up today, right? Like most of the vol from a day like Tuesday, which was 2 days ago, happens overnight. It's not happening intraday. So like if you're going to put on an intraday 0 DTE thing, that's a good indicator of comparing, when are these moves actually happening?
Right. Interesting. That's a good point. Yeah. Yeah, I know. These ranges have. You're right. They have been gaps like mad, haven't they? My goodness.
Well, it took us 6 weeks to kind of grind down from 4,500 to 41, and now it's 2 weeks to rebound back up.
It feels like it was 2 days, quite honestly. I mean, honestly.
Yeah, of the 2 weeks, there was probably like 3 distinct days got us 80% of the way there.
I mean, it's like you like today. I said to myself, this thing's got to have a little bit of the steam let out of the balloon here. At some point, but it has not. I mean, what are we at? 2:00 now? It has not sold off at all. It just kind of grind.
The FOMO buyers just keep coming.
I love it. All right, cool. Well, very good. Just so everyone knows, this is a pre-recorded show. It's going to be aired on Thursday. We're actually talking about Tuesday data. Sorry for that, but Jason spilled the beans on us. Wake up over there. Yeah, happy camper. All right, very good. We'll chat. Oh no, next week's Thanksgiving, so Ixnay on the Thanksgiving version, right? That is
another reason to sell vol.
Another reason to sell vol. Yeah, how's that going? No, I think we're gonna skip next week, so we will see you in 2 weeks. Very cool, right. And I'll have more wine in my cellar as a result of the Napa trip for sure.
Ooh.
I love it. It's not like your cup of tea, Mark. You like that French stuff, but
Yeah. Unabashedly Francophile.
There you go. I love it. I like French wine too. All right, good deal. You guys have a good rest of the week. I'll talk to you in 2, or probably sooner, but you know what I mean.
Happy trading.
Happy trading. Bye, guys.